studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
At this stage, we have identified a common problem. The shareholder has received money from the corporation during the year, but those withdrawals were never formally recorded as salary or dividends. As a result, the accounting records now show a shareholder loan account with a debit balance. In our example, the balance is $85,000. Many business owners assume that this balance can simply remain on the books indefinitely. However, from a tax perspective, that is usually not the preferred outcome. Accountants and tax advisors generally want to eliminate, or clear, the shareholder balance before it creates additional tax issues. The question then becomes, how do we remove the balance? In most owner-managed corporations, there are two primary solutions. The first option is to treat the withdrawal as a dividend. Under this approach, the corporation formally declares a dividend to the shareholder. The dividend is then applied against the shareholder loan balance, effectively converting the withdrawal into a distribution of corporate profits. The second option is to treat the withdrawal as salary or a bonus. In this case, the corporation recognizes employment income for the shareholder. That salary or bonus is then applied against the shareholder loan account, eliminating the balance while creating employment income for tax purposes. Although both methods can achieve the same objective of reducing the shareholder loan balance to zero, they produce very different tax results. A dividend creates dividend income and is reported on a T5 slip. A salary or bonus creates employment income and is reported on a T4 slip. Because the tax consequences are different, choosing between these two methods is one of the most important planning decisions faced by accountants working with owner-managed corporations. The key takeaway from this slide is simple. When a shareholder loan balance exists, accountants typically do not leave it unresolved. Instead, they usually convert the withdrawal into either a dividend or a salary, depending on which approach produces the most appropriate tax outcome for the shareholder and the corporation. In the next sections, we will examine each of these two methods in greater detail and compare their advantages and disadvantages. The first method for eliminating a shareholder loan balance is to use a dividend. Remember our situation. The shareholder has already received money from the corporation during the year, creating a shareholder loan account with a debit balance. In this example, the balance is $85,000. One way to clear that balance is to formally declare a dividend. Conceptually, what we are doing is reclassifying the withdrawal. Instead of treating the amount as money owed back to the corporation, we treat it as a distribution of corporate profits to the shareholder. The process is relatively straightforward. First, the corporation determines that it has sufficient retained earnings or profits available for distribution. Next, the directors of the corporation formally declare a dividend. Once the dividend is declared, the amount of the dividend is applied against the shareholder loan account. As a result, the debit balance is reduced and, in many cases, completely eliminated. After the adjustment, the shareholder loan balance may be reduced to zero, meaning the shareholder no longer owes money to the corporation. However, eliminating the shareholder loan does not make the transaction tax-free. Because the withdrawal has now been characterized as a dividend, the shareholder must report dividend income on their personal tax return. The corporation will generally issue a T5 information slip showing the dividend amount that was received. There are several advantages to this approach. It is often simple to implement as a year-end adjustment. There are no payroll remittances required. CPP contributions do not apply to dividends, and the administrative process is generally easier than processing a large salary or bonus. However, There are also disadvantages. Unlike salary, a dividend is not deductible to the corporation. This means the corporation does not receive a corporate tax deduction for the amount paid. In addition, the shareholder now has dividend income that must be reported personally and taxed according to the dividend tax rules. The key concept to remember is that a dividend solution does not repay the shareholder loan with cash. Instead, it converts the withdrawal into a profit distribution. In other words, the corporation is effectively saying, rather than treating this as money owed back to the company, we will treat it as profits distributed to the shareholder. For many owner-managed corporations, using a dividend is one of the most common ways to clear a shareholder loan balance at year-end. The second major method for clearing a shareholder loan balance is to use a salary or bonus. Just like the dividend method, the objective is to eliminate the debit balance that exists in the shareholder loan account. In our example, the shareholder has withdrawn $85,000 from the corporation during the year, creating a debit balance of the same amount. Instead of treating that withdrawal as a distribution of profits, this method treats it as employment income. The process begins when the corporation declares a salary or bonus for the shareholder. Since many owner-managers are also employees of their corporation, the company can compensate them for services they have provided to the business. Once the salary or bonus is approved, the amount is applied against the shareholder loan account. Rather than requiring the shareholder to repay the corporation, the salary is used to offset the outstanding balance. As a result, the shareholder loan account is reduced and can often be brought down to zero. Because the payment is considered employment income, the corporation must issue a T4 slip. The shareholder then reports the amount as employment income on their personal tax return. One of the biggest advantages of the salary approach is that the corporation generally receives a tax deduction for the salary expense. This can reduce the corporation's taxable income and lower corporate taxes. Another important benefit is that salary creates RRSP contribution room. Since RRSP room is based on earned income, many business owners choose salary specifically to support long-term retirement planning. Salary is also recognized as employment income, which may be beneficial for financing applications, mortgage approvals, pension calculations, and other situations where documented earned income is important. However, the salary method also comes with additional complexity. CPP contributions may be required. Payroll remittances must be calculated and submitted. Payroll records need to be maintained, and in some situations, gross-up calculations may be necessary because the shareholder has already received the cash during the year, but payroll deductions still need to be accounted for. When we compare the two approaches, a dividend is generally treated as a profit distribution and reported on a T5 slip, with no CPP contributions and no corporate tax deduction. A salary, on the other hand, is employment income reported on a T4 slip, usually subject to CPP contributions, but it provides a valuable corporate tax deduction and creates RRSP room. The important lesson is that both methods can eliminate the shareholder loan balance, but they produce very different tax consequences. This is why deciding between salary and dividends is one of the most important tax planning decisions for owner-managed corporations. The optimal choice depends on the shareholder's personal tax situation, corporate tax objectives, retirement planning goals, and overall compensation strategy.